you should be seeing my my PowerPoint screen now, right?
Yes.
Good. All right. So a couple of things. As usual, we're going to spend time in the doing some review from last week on market multiples, and then we'll launch into a discussion on localizing the valuation estimation, and then a little bit of time spent on interpreting model outcomes and assessing model applicability. And do I have applicability spelled wrong there? I did, didn't I? Yeah, I think so. So I'm not going to spend a lot of time on these last two items unless you ask me to. I'm happy to, and I'm going to go over some general things that I really do want you to know, but I'm happy to delve deeper into that if you guys would like me to when the time comes. But we'll spend most of our time in looking at localizing the valuation estimation. And this is probably going to be particularly relevant to the final project that you're working on. So which is why I save it to the end. But in reality, it's simply tools and mechanisms we've been building the entire time, but we're going to talk about it rather than on a global basis for the entire firm. We'll talk about these on a localized basis for a particular project or acquisition or some such thing. And I'll walk through an example of that. It's an interesting example. I don't know how applicable it is for all companies, but I think you'll appreciate why I chose it when we get there. So I want to come back to this issue of should an asset's value differ based upon the model we're using to estimate it. So I'll ask you guys this question again. Do you think we should have different model outcomes? And if we do, what do they represent?
I think the market multiple is interesting. I mean, it just usually yields I guess it all depends what the multiplier is, but I don't know. That one seems kind of, because you said that's the majority of what we see or what you see when valuation is being conducted is the.
Yeah, I virtually always see, and when I do evaluation, include a multiples-based valuation, both in just applying the multiple directly to the EBIT, EBITDA, or free cash flow from the subject year, or doing a full FMM, which is taking some discounted cash flow to free cash flow and then applying the multiple. So anytime I do evaluation, I do both of those, and every valuation I've ever seen has had at least a basic multiple applied to it. And then it's also had a basic discounted cash flow.
Which one of the three that we've seen is contested? Are they, contested from the parties in question, or is that a thing that happens? I don't know.
Yeah, well, oftentimes one, both, all, or not. So it's so hard for me to answer the question the way you've asked it, Jason. I can tell you that depending upon who has contracted with the valuation consultancy and what their purpose is, sometimes these outcomes and valuations are contested, sometimes not. Sometimes other parties that weren't the ones that did the contracting but that have an interest in what the value is will contest them. Sometimes that contestation is done by the IRS. Interestingly enough, because so many valuations are actually done as a function of various tax purposes. You might realize that if there is a married couple and it's choosing to divorce, or just a palimony couple choosing to divorce, very often a valuation of a business asset has to go and take place for separating out the assets, the palimony or marital assets. So very often one side or the other will contest those. Now, and it just depends on which numbers are most serving their particular individual needs or purposes as to what might be contested, or if it's going to be contested. So I'm going to argue that the value of an asset shouldn't be a function of, or shouldn't differ because some analyst used different models. If Jason is the analyst and Heather's another analyst and Nate's another analyst, they might be using 3 different models, but at the end of the day, the asset's worth whatever the darned asset's worth, right? And if it's a shoe company, or if it's a tire company, or if it's a fashion concern, it makes no difference. The asset is worth whatever it's worth. So we might argue that the most accurate valuation is the market valuation. And in this case, that would be the valuation that is agreed upon by 2 economic agents that are bartering or negotiating in a marketplace. Well, as you're probably aware, a comparable set of transactions is available. And from that comparable set of transactions, you apply multiples, or you find multiples. It's one of the ways we can find a multiple. So we might think that a multiples-based or a market-based valuation metric would be more accurate, but not necessarily. It just, the different models will in fact have slightly different values. In fact, usually it's very common to see a spread of as much as 10% from the low to the high in the valuation model outcomes. That doesn't mean that they're wrong. It means that we're forming a basis for a range of values for an asset. If I want to go buy Nate's car, Nate's got a 2017 Corvette Z01 that I'd like to buy. It's Nate, it's just bitching, and it's the right color, brother. I'm telling you now, okay?
That's too bad. I'm not selling.
Okay. And what he wants for it, though, is meaningfully more than I want to pay for it. Well, it doesn't mean that he's wrong. It doesn't mean that I'm right or wrong. It means we just have to come to an agreement, or we walk away, and I don't buy it, and you sell it to somebody else, right, Nate? I don't know why you're selling that thing unless it's to buy a new 2020 C8. But okay. And if you're not doing that, don't sell it. So my point is, the model outcome differences don't mean the asset has truly different values. The asset has the value the asset has, but the model outcome differences may well inform a range of acceptable values within which a potential buyer and a potential seller, both of which are being prudent and looking for reasonable returns, may choose to negotiate. Okay? Well, we know that there's a small grouping of enterprise value multiples that we're interested in, because those inform either the continuation value in a multiples-based valuation, or maybe the entirety of the value in a multiples-based valuation. And though there are many more than the 4 I have listed, but a sales, or sometimes referred to as a revenue multiple, an EBITDA multiple, an EBIT multiple, a free cash flow multiple, are going to be the 4 most commonly applied multiples out of this range of 8 or 10 enterprise value multiples. And you might remember I shared with you a multiples quick sheet that I think has 7 or 8 of them on there, the 7 or 8 that are most commonly considered, but these 4 are more common, the most common still. And I would tell you that of these, the EBITDA multiple is probably used more than any other. I prefer personally the EBIT multiple, and it might be interesting for you to know why that is. EBITDA has erased depreciation and amortization from the cash flow variable. And I think depreciation and amortization, being a functional operating expense and giving a nod, if you will, to the expensing that capital asset across from the balance sheet to the income statement, I think that that's important. Some people don't, but I tend to. There's yet one other that's often used, and that will be an SDE. SDE, or seller's discretionary earnings multiple. And you can think of seller's discretionary earnings as a EBIT adjusted and tax adjusted form of cash flow. And without going into much more detail about it, you just may come across that term in a lot of the literature. So those are the 4 that are most commonly utilized. Obviously, these become a model when we go from the multiple and that little bit of algebra and we extend it to solve for an enterprise value, because enterprise value is the estimated value that we are calculating. And if we go a step further, we can say, and again, I gave you some Dravana examples, we can say that it creates a good model when we're using the cash flow variable. In this case, EBIT is one of the cash flow variables. It's a variable that leads to cash flow. We're using that from the next period, so EBIT at time 1. And I've given you here EBIT at time 0, and so this isn't really the model yet. It becomes really a model for us when we are using it to estimate something. In this form, we're just taking these numbers straight off the balance sheet and income statement, right? We're not estimating anything. We know what this is. But when we go ahead and move from using the historical value for the same year for EBIT and enterprise value, when we move to using an EBIT or an EBITDA or free cash flow or whatever it happens to be for the next period of time, we turn this into a model. And now we can estimate a value at time 0 based upon some cash flow in the next period of time interacted with some terms, no different than if we were applying the Gordon growth model consideration. The math is different, the algebra has changed, but we're still using some estimated value for time now based upon some projected value for the next period of time, and then interacting that with some other algebra to get the thing done. Does that all make sense? Any questions about any of that?
Quick question, Rick. So if there is a industry multiple, is that misleading then?
What do you mean by industry multiple, Jason?
So is that such a thing? I mean, because it's part of what I looked up on for the project is, an industry, although I think it was EBITDA, but, it listed the multiple or various business entities and the average multiple that they used. And we derive it, and then we actually do forecasting in the model, and we get, so I'm just wondering, take it with a grain of salt what the market multiple is?
Yeah, so I wouldn't take it with a grain of salt. And
Okay.
So now that I understand what you mean, yes, it is viable. In fact, if you looked at that cognate data table or Thomson 1, both of which I referenced as multiple sources when we first discussed this, you're going to find that those put together in the multiples by industry classification. They don't give you a lot of additional detail as to the sample from which that average was taken, okay? But that would be an average for the firms that they've deemed to be in that industry. And it's by standard industry classification or SIC code or NACE code. So that's valuable, no different than it's valuable to say if you're buying a house in Pepperwood, part of Sandy, or in Draper Heights, that those houses are going to sell pretty much based upon X dollars per bedroom, X dollars per square foot, Y dollars per bathroom, etc. Okay, so these become comparables, and just generalizing it for an entire industry and applying that industry's multiple against our one company generalizes it, in my way of thinking, a little too much, and any valuation analyst would tell you this, okay? Just a little too much, but it is a good broad brushstroke. It's an easy, quick, and dirty way of getting into the right ballpark, if you will, into the right range. But we then have to make adjustments based upon how like the industry the particular firm we're trying to value actually is. If it's very similar to the rest of the industry, cool, then maybe that industry multiple is applicable. But if the firm that we're dealing with has a dynamic, maybe it has some monopoly power because it controls a very dynamic and high demand product. Maybe it's a leader in the industry. Maybe it's bigger or smaller, older or younger, whatever, well-resourced or not. We might have to change that multiple based upon that, because that, whatever that change in condition is, probably affects its likely growth rate. And remember that a multiple is just a numeric simplification of the company's expected growth rate more than anything else. Now, it's got some other algebraic components, right? We know that ROIC is in there. We know that WACC is in there. We know that tax is in there. If it's an EBITDA multiple, depreciation's in there. But at the end of the day, the one variable that we have to guess at and the one about which the multiple is most sensitive is the G, or growth variable. Does that help?
Yes, that helps. I was just thinking in terms of, let's say a company evaluates based on a market multiple, and I somehow know that their cash flow is not what it should be for that multiple. I mean, that impacts my believability of them using the market multiple.
It does.
Okay.
Now, you might remember last week I went to the detail, I believe, of showing you a panel of subject firms from Deal Stats. I believe we went through this and looked at 10 or 12 different companies that were comparable firms in a marketplace, and we ranked them by profit margin, and I think I ranked them separately by operating margin, and then separated them into quintiles and said my subject company, the one I'm trying to model or estimate today, is most like these in the fourth quintile. Well, if I'd have taken the whole industry average, I'd have gotten a blending of the whole industry. I wanted a blending of just the best firms in the industry, or the firms in the industry with a profit margin or an operating margin as a percentage most closely associated with mine. So what I'm doing here is I'm lining them up. I'm trying to get like for like as much as I can. Okay.
Thank you. Yep.
And just as in real estate or any other kind of valuation, that's exactly what we do. So as we move on, we've got to select the right multiple form for what we're trying to get at. So a sales or revenue multiple is principally going to be used for an early stage venture. A firm that doesn't have a positive operating income yet, may not even have positive cash flow yet. But it doesn't mean it's not worth something. It's just we can't value it on its EBIT or EBITDA or free cash flow. So we value it based upon its revenue. If we were going to apply a discount rate into here, we would probably apply a more aggressive discount rate, because we know that the firm that doesn't have a positive cash flow or a positive EBIT or EBITDA probably has more risk associated with it, in which case it would warrant a greater discount rate. Firms that are going to be using an EBITDA multiple probably have some good operating incomes, but they may also have some significant capitalized assets. Not always, but most of the time. So I might apply an EBITDA multiple to a Central Camp Railroad, while I would never apply an EBITDA multiple to Leland Manufacturing, which is, I think, the next problem set that you're going to do. I think it's the last problem set that you're going to do. Not only is Leland Manufacturing younger than most railroads would be, but Leland Manufacturing has precious little in the way of capitalized assets. So I wouldn't put a model here that uses DA or depreciation if I don't have much to depreciate. So it becomes a little irrelevant. An EBIT multiple I might apply again to a firm with good operating incomes, but with limited operating assets, or maybe none at all. And then a free cash flow multiple I might apply to a firm with good incomes and some capital growth plans, whether they've got those capital assets on hand today or they just have them in their planning, their forecasting. So those would be where you would most commonly see these multiple forms applied. But remember, I'm saying commonly. This falls under the heading of the rules of finance are all set in stone, except for when they're not. So there are companies that will value, or their analysts will value them based upon sales, even though they've got good operating incomes. It's just the way they've chosen to do it. And there's some industry types where that might be more appropriate than others. As we move a little bit further, we have to think, well, how do we come across this multiple? Well, we know we can go back and look at the company's history. We can see what its enterprise value was and say its EBIT on any given date or any point in time, if the balance sheets, income statements, etc. align, and we can come up with its historical multiples based upon those pieces of information. And you've come up with one for Drovana, I think it was 9.28. We may have decided that that was a very high multiple, and we may have picked it apart, but that was one that we observed on that date and time. Or we might say, well, look, I think my company can become like Stevie's company one day. I think we can become as well managed as Stevie's company someday. We're in the same industry. We're in the same product areas, but she's just further along this curve than I am. She's a better manager. She's been more innovative than I am with my company. So if I can manage my company like Stevie manages hers, maybe I should be able to aspire to the same kind of multiple that Stevie's company has had. So that would be an aspirational target. You're only going to have an aspirational target to the extent that the company you're comparing yourself with is in your same industry grouping and has enough in common with your company to make then this comparison. If it doesn't, you're just stretching a little too far. And you might measure this on ROEs or profit margins or operating margins, but then you're going to look at whatever this aspirational multiple might be. We might look at comparable values by taking recent transactions, like I showed you last week with deal stats, or like you might think about the way a real estate agent will go ahead and value a company, or rather value a home by using comparable transactions that have happened in the market in recent periods of time, trying to align those with your company as closely as you can, and then identifying the average multiple of the chosen type amongst those companies that have the transactions that are in your sample grouping. And then finally, we can use all of our technical prowess, and we can put together a multiple using the algebraic form. And we might do all four of these and come up with some averages. We might do just one of them. We might just put our finger up in the wind and try to figure out which one we like the best. Hopefully not. That's not terribly credible, of course. But I would say that more companies than not are going to take a critical look at comparable values and comparable transactions as they're establishing a multiple. Any questions about that? So here again is how we look at the algebraic form. I won't go into detail about this because we did before. I'm not going to go into any detail about how we got to the numbers, the algebraic proofs and stuff. And if you want that level of boredom, you're certainly welcome to go back to last week's video and go through there. I think, or you can just believe me with them. And then we can look at, well, we can use this multiple form either as a singular broad brushstroke up here as we think of it as a model, just looking at the multiple times the cash flow variable, or we can get a little bit more in depth with this, and we can say we can use a hybridized model, which I referred to as the forward market multiple model, where the present value of the discounted cash flow is simply using free cash flow as we have in virtually every other model form we've assessed. But the continuing value is now using this different mathematics. It's using whatever the multiple is times the appropriate cash flow variable. And when I say appropriate cash flow variable, I'm talking about the cash flow variable that was active when that comparable, historic, aspirational, what have you model was assessed and the multiple was selected. And we put those together just as we normally would. The present value of the discounted cash flow plus the present value of the continuing value, this time using a multiple, becomes the value of the asset.
And sorry, what was that? How do we find the FMM?
How do we find this number, Scott?
Yeah.
Okay, we're going to find the number.
Or is that the
history, aspiration, comps, or algebra, or a combination of them?
Well, isn't that just doing the EBIT times the multiple?
Well, in this particular case, yes, but we have to decide, we're going to get back to that model, we have to decide what the multiple is. So if we're going to take the multiple that is in the company's past, so we observe it in history, that's fine, but that's how we got it, okay? It may or may not be accurate. In fact, I would tell you I would never take it from one particular moment in the company's history, because just like the Mira-Dravana case, in a particular year, it may be an outlier for the company. We identified that Mira-Dravana should be more like a 4.25 multiple, but for that particular year we were looking at on the financial statements and financial information, it calculated at 9.28. Well, that was an anomalous year. I might take 5 years of worth of the multiples for a company and average them, or 10 years and average them, that would be a more credible way of taking the historical multiples.
Okay, so and then the EBIT that you're using, that's the first year of the explicit period, right?
No, this is a continuing value, so it's going to be the first year of the continuation period.
Oh, okay, okay. This is making more sense now.
Good.
That makes more sense.
We always use the cash flow input from the first year of the continuation term or period to find the continuation term or value. It doesn't matter what continuation form we're using, it's always based upon the next year's cash flow input, whether that really is cash flow or just one of the inputs leading to cash flow, like revenue
Okay.
or EBIT or EBITDA.
Got it.
Cool.
Thanks.
You bet. Well, I then went ahead and walked you through some Mira-Dravana numbers. And you can do that on your own, of course, and you have done so. I won't take the time to do that again right now. But we ended up with a couple of different values. We then talked about the utility of growth rates with those as we reverse engineer one of the multiple forms to solve for growth. And that's what you see me doing in this algebraic proof. And then where we apply numbers to it. So when you go back and look at this, there's a lot of ways you can use a multiple, and there are numerous places we can find a multiple. You're not going to just choose one and say, this is my multiple. You're going to comprehensively consider what this multiple means and how it compares, why it lines up or why it doesn't line up. And then you'll apply it based upon best practices. Whoops, went a little too far. Sorry about that. Okay. Any question as to how we got to this point last week before we move on? I want to talk very briefly about Leland Manufacturing. So I'm going to bring it up for a minute, and then we're going to be done.